You guys like my suit? I don't even have on pants, man. I'm taking this off. Welcome and welcome back to the channel that simplifies the stock market. Now in this video, we're going to be going over 4 tips for actually making money in the stock market. Now there's a chance that if you're watching this video, you saw the whole fiasco with GameStop recently. And you might have heard how the stock price went up close to $500 and somebody probably sold you a dream and said, hey, it could keep going up to the moon. That's stock market lingo for saying the stock price is going to keep going up. And for a lot of people, if you're really being real with yourself, you didn't understand the first thing about stocks or how stock prices go up or down, but you heard that a lot of people were getting money. And naturally, you wanted to get money too. So you took your $200, you opened up a Robinhood account, and you bought a fractional share of GameStop because you're going to turn 200 into 2,000 in a few hours. Duh. So you bought it here at this price. And then Listen, I'm not laughing at you, but if you lost money with GameStop, one day you're going to look back at this moment and you're going to realize just how silly that was for you to put your money with them in the first place, and you're going to laugh too. So it's okay. Don't get offended. Calm down. All right, calm down. Now, when I first started out in the stock market, I made mistakes and lost money too. And now I can look back at my mistakes and laugh, which is why I can look at your situation and kind of find it a little funny. But you're going to correct your mistakes. You're going to learn. You're going to correct them, which is why you're here, honestly. I mean, that's why you clicked on this video. Now, in giving you these 4 tips, I'm going to highlight my mistakes in times where I lost money so you can learn from my mistakes. You feel me? So let's just go ahead and get into it. The first tip number 1, before you buy a company stock, you need to understand what the company does and how it makes money. Basically, you need to understand the business. And here's where I tell you about a couple of my mistakes and how I lost money concerning the first tip. Now, one of the companies that I lost money with was China National Offshore Oil Corporation. Now, I bought it at this price, and then the price dropped, and I held it for a little while, but then I sold it at this price. I was like, whoa. But why did I panic and sell it when the price dropped instead of buying more because it got cheaper? When I was being honest with myself, it was because I didn't truly understand the business. I didn't understand all the ins and outs of how they make their money. I didn't truly understand the products that they sold. So because there was so much that I didn't understand, I didn't have that instinctual feeling for where business would go in the future. If I did understand the company and the products that they sold, then, I would just brush off the price drop and say, this is just temporary. I feel like business will continue on and grow into the future. So I need to buy some more stock right now while it's cheaper, because in the long run, I feel like the stock price will be much higher. Like, why the would I buy a Chinese oil company? I never even been to China. No, but not visiting China has little to do with it. I actually have a Chinese real estate software company in my portfolio right now. And as you can see, the stock price is doing pretty well for me. But the real reason I shouldn't have bought the oil company in the first place is because I don't understand the first thing about the oil industry. I didn't understand, and I still don't understand, why barrels of oil will be one price one day and then another price the next day. Of course it has to do with supply and demand, but who the f*** engaged supply and demand on oil? Not me. I didn't understand the first thing about their energy business. Just look at this video right here. I don't understand what's going on here and how this makes a final product. Do you? But let's just chalk this up as my failure and an example of what not to do in the stock market. But hey, shout out to China. Now on to the second company that I had absolutely no business buying. Now with this company, I bought some shares here, and then I bought some more here, and then I bought some more here. Like, I really must have been feeling this company, huh? My goodness. No, I sold it here. The company was Intel. But again, why did I not feel comfortable and confident when the stock price dropped so I can buy some more shares at that lower price instead of selling them at a loss? It all boils down to me not truly understanding the business and the products and the services they sold to make money. Like, this is what Intel sells.
Look. Look at this. Somebody come look at this. Look at this. Somebody come and look at this. Look at this.
Maybe if I would have watched this video by Peter Lynch before I thought to buy Intel stock, maybe, just maybe I wouldn't have bought it.
And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money, never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts.
But then again, maybe I would have bought it anyway and learned the lesson the hard way because Intel was trading at 10 times earnings while its main competitors were trading at close to 100 times earnings. Take the lesson from me, don't be hard-headed. And now you're probably thinking, well, how will I truly know that I understand the business, I understand the products and the services that it sells, and I understand how they make money? You won't. I'm playing, there's a test for that. If you buy a company's stock and the stock price drops and you start to feel uneasy or nervous or not confident, it's likely because you don't understand the underlying business and you don't have confidence in their prospects for the future. Now, on the flip side, if you do understand the business and you understand how they make money and you have confidence in their prospects for the future, then you likely won't be too fazed about the stock price in the short term. There's honestly times where I don't even look at the value of my portfolio simply because I'm confident in the companies that I own. But let me give you a specific example of what confidence in a business and its prospects for the future looks like. Recently, I bought some shares in Progressive, the insurance company with Flo. She's a little quirky, but they got cash. Now, I understand how Progressive makes its money, and I think it'll be around and growing for years into the future. So this is the price that I bought it at initially. Now, for each share that I own, this is the cash that I received from Progressive for being part owner. This is the dividend. And then the stock price dropped around 10% to this price. So I bought some more because it still pays this dividend. So now I'm getting this same dividend at a cheaper price. But let me quickly explain this whole dividend thing. So Progressive earns and generates cash from serving its customers. And now I'm part owner of Progressive, so they give me some of that cash. Got to pay me. Now, if you buy shares of Progressive, you'll be part owner too, and they'll pay you as well. So I'm not special, okay? But again, remember tip 1. If you don't understand Progressive, the company, don't buy it because you can buy it and then the price could go down and then you won't understand what's going on. So you'll panic and sell it at a lower price and then you'll just lose money. Like, forget what I say. Just because I bought the company and added it to my portfolio because I feel great about the business and the prospects for the future, like, do your own research and make up your own mind because I could be wrong. Though I don't think I am. Now, right now, all the Robinhood and GameStop folks are probably watching and thinking, but I know how GameStop makes money. They sell games, duh. But that brings me to my next point. Point number 2, always look at the financials of the company and don't put your money into companies with poor financials. If you put your hard-earned cash into a company with poor financials, you're basically asking to lose your money. Picture this. Your third cousin, twice removed on your daddy's side, comes to you and says, hey, you should put your money with me. I'm going to make a lot of money soon. I'm selling blankets for cats. Now, the first thing you need to do is question that whole business idea. But give it a fair shake. Give it a fair shake. Your first thought should really be, are a lot of people paying a lot of money for blankets for cats? And you know where you can find that information out at? You can find it in the All right, you beat me to it. You get it, I understand. Calm down. Financials. Now, I've shown this in earlier videos, but there's three main financial statements that you need to be familiar with. The income statement, the balance sheet, and the cash flow statement. Now, when I say you need to be familiar with these financial statements, what I really mean is you need to read them, you need to know them, and you need to understand them like the back of your hand because they can tell you so much about a company. The income statement can tell you if a company is profitable or unprofitable. What do the company's revenue trends look like? Is the company growing or shrinking? Is the company increasing sales while cutting costs? Etc., etc., etc. The cash flow statement can tell you what the flow of cash looks like in the business. Bottom line, the cash is vital. Is the company losing cash or earning cash from its operations? Is the company spending cash to invest in itself? How are the managers of the company handling the company's financials? Are they taking on a lot of debt? Are they selling off pieces of the company for cash? Or are they paying off debt and buying back outstanding shares of the company? Do they pay a dividend? And if so, have they been paying it consistently? What about free cash flow and operating cash flow to capital expenditures? The balance sheet can tell you if a company is solvent by comparing its assets to its liabilities. Is the company heavily leveraged by debt? And on and on. That's a lot of huh? Yeah, I know. That's why you need to be knowing what's going on before you start throwing your money into these companies. Memory water. Don't mind me, I'm just giving the sponsors a little preview. Now, of course, you won't understand all this in one sitting. Some people probably heard that and said, you have to get familiar with the financial statements by practice, by reading them over and over again, and then you'll get better at it, and then you'll understand exactly what I'm talking about. But at this point, after watching this video, if you still buy a company stock without first looking at the financials, and by that, I mean by at least glancing over the financial statements to see if anything pops out and catches your eye, then I mean, you're just asking to lose your money. So tell your third cousin on your daddy's side to show you the financials of his cat blanket business before you give him your money. They might start sweating. I mean, but that's the thing. On the third Wednesday of last month, I had them, and then, yeah, all right. But that's all for tip 2. Now, tip 3. Tip 3 is to buy a company's stock at a great price. You know, even if you buy a great company, but you pay too much for it, you're probably not going to make a lot of money. And you might even lose some money. And if you overpay for a terrible company, I don't know what to tell you. You asking for it. Now let me see if I can paint the picture like this. Put yourself in my shoes. We're going on a trip. We're not going anywhere. Imagination. Now say we want some oranges. So we take a trip to the store and see that oranges are 50 cents per orange. So we buy our oranges, we leave, we eat them, but in a few days we want some more oranges, so we go back to the store. And this time we see that oranges are $5 per orange. Would you look at this and say, oranges are getting more expensive. I should buy some more? Of course not. You probably look at this and say, well, so much for oranges. What else they got? So you look around and you see that apples are $4 per pound. What would you do? Them oranges. Listen, as long as these apples aren't rotten, I'm eating apples. I couldn't care less if everyone is saying, no, put down the apples, pick up the oranges. The oranges are the fruit of the future. I couldn't care less. I'm not touching oranges until they get cheaper. Y'all are ridiculous and you're driving up the price. Speaking of Apple, as of right now, it's selling at 35 times earnings. Now we can take this figure and compare it to historical prices, just like we did with the example of the grocery store and the oranges. So we head on over to macro trends and we see this. Ain't that about it? In 2018, Apple was selling at 12 times earnings. Now, that was a great time to buy it. Not today when it's much more expensive. And to wrap up this point of buying at a great price, make sure you're paying attention to how much you're paying versus how much you're getting for what you're paying. For instance, with Shopify, each share earns this much. And each share is priced at this much. Giving Shopify a price to earnings ratio of and Shopify doesn't pay a dividend. If you make a habit of paying this much for stocks, you're bound to lose money. And to bring it home, the last tip number 4, is to keep learning. I mean, look what you're doing right now. YouTube University. I attend YU as well, you hear me? YU on my chest. I also learned from the likes of Warren Buffett, OG Warren, Peter Lynch, you saw him in the video earlier, Benjamin Graham, and so on and so on. I'll keep this point short because I think we get it. Keep learning. And there you have it, the 4 tips to making money in the stock market. Understand the company and how it makes money. Always look at the financials. And don't invest in companies with poor financials. Buy at a great price and keep learning. Now, if you follow these 4 tips, you'll likely be a much more confident investor. And chances are, with that confidence, you'll make a lot of money in the stock market in the long run. And hey, if you made some mistakes along the way and you lost some money, it's okay. You're here now. I'll help you out. I'll teach you the game so you can be successful in the stock market. So, take that journey with me and subscribe. See what I did there?